The Paper LBO is one of the most popular questions you'll get in private equity interviews at the analyst, associate, and senior associate level. The reason why it's so popular is because it tests all of the key mechanics of an LBO, which is the key model in private equity, but it's very easy to administer. You can do it either orally or just giving someone simple instructions. So in this video, we're going to explain how to do the Paper LBO, the format that it typically comes in, all the mechanics that you need to know, and then we'll go through an actual Paper LBO question. And this video is a sample of the private equity recruiting course, which covers how to build an LBO in Excel, as well as how to do case studies. In order to properly build a Paper LBO, we're going to cover the following concepts: enterprise value, sources and uses, forecasting financials, free cash flow, and the rule of 72. So let's start by talking about the format of the Paper LBO. And as the name suggests, it's completely done on paper. You don't have to open Excel at all. So in a typical Paper LBO, these are the rules. The interviewee will complete financial forecasts by hand. They'll typically be given less than 15 minutes to complete the entire thing. The numbers provided will be relatively simple to compute, so you're not going to get very strange decimals or very difficult numbers, and you'll also be allowed to liberally round numbers. So now let's cover the steps that you need to compute a Paper LBO. And this is not just for Paper LBOs, this is for every LBO, every investment model in the world. And I just want to impart on you the first principles. Whenever you're building an investment model, really what you want to be aware of is how much money you put in and how much money you're getting back. There's a bunch of other factors, but it ultimately boils down to the simplicity of how much money you're making atop your own investment. So there's three main steps I would say when doing an LBO. The first is determining the transaction assumptions. An LBO is a negotiated deal, and that means two parties will have to have agreed on a specific price with specific terms. So the first question, very simply, is how much are we purchasing the company for? If we're doing an LBO, which stands for leverage buyout, that essentially means we are buying an entire business or an entire asset. And as such, we need to know how much total money is being deployed to purchase this business. And the next question is how much debt and how much equity is used to purchase the company. This is really important because the equity amount is going to represent what we as equity investors have to put up. It's very similar to putting a mortgage on a house. When you take out a mortgage, that's the debt piece that we'll be concerned with. And then we have the equity piece, which represents the investment that we will put in. And that's another big corporate finance rule. Whenever you're financing any kind of business or an acquisition, it can either be done in debt or equity. The next step is to forecast out the financials. And actually for an LBO, all we really need is an income statement all the way down to free cash flow. So we don't have to do an entire three-statement model. In fact, a lot of the times you'll find that this is actually relatively simple. It'll only be about 7 or 8 lines of actual arithmetic. So a real exercise here is to see how long we intend on holding the investment. In private equity, on average, it's probably between 5 and 7 years. But for a Paper LBO, oftentimes I've seen it's closer to 3 to 5 years because it's just easier to compute fewer numbers. And our ultimate purpose here is to see how much free cash flow this asset or this business is going to generate over that time span. And the principle here is that we are going to be using cash generated from the asset or the business to pay down the debt. And finally, the third step is to calculate the debt pay down over the forecast, as well as the returns analysis. Now this sounds complicated, but it's going to be a direct result of what we just calculated. The first thing we're going to do is look at how much debt was paid down in the forecast. The second thing is to look at how much cash we are getting back on our investment. Remember that this figure is essentially the key item we've been looking for this entire time. We want to look at the end of the investment period after we have held the business, how much cash we're getting back. And finally, we're going to take these numbers, put it into a clever formula called the rule of 72, and use that in order to determine the return profile of the investment. So I hope you followed up to this point because we are about to dive into an example question. So this, I would actually say, is a relatively simple Paper LBO, something they might administer during an analyst level interview. So assume that we are a private equity firm purchasing company Alpha at the end of 2021. The purchase multiple is 10 times LTM EBITDA. The company has $200 million of revenue in 2021, which grows at $25 million annually. EBITDA margins at 50% that remain flat. D&A and CapEx both 10% of revenue, also flat throughout the forecast. No change in net working capital. The tax rate is 50%, which makes it simple to calculate. The initial leverage, which is how much debt we're going to put on the business, is 5 times LTM EBITDA. We have an interest rate of 10%, which is going to be applied on the debt, and we're going to assume an exit after 3 years of projections at 10 times LTM EBITDA. And that's all the information you need to calculate the IRR and MOM of the business. So why don't you pause right here if you want to try it, and then we're going to start jumping into the answer. So the first thing is to look at how much the company costs. How can we figure this out? Well, we have the purchase price multiple, which is 10 times LTM EBITDA. Now, if you remember from the comps video, what we have to do here is multiply this by EBITDA. But we're not given EBITDA directly. So what we have to do is multiply the figure of $200 million in revenue. That's how much we generated in 2021. And we're going to multiply that by the constant EBITDA margin of 50%. So 200 times 50% is $100 million. 100 million is our LTM EBITDA. LTM is the last 12 months. And then we multiply 100 by 10 to get to a $1 billion purchase price. So this is that first item. This is how much it costs to buy the entire business. If you were selling your family business for $1 billion, this is how much total cash you would be getting. Now, the next piece is to figure out how this was financed. Again, think about the house analogy. How much of this was a mortgage? How much did we put up of our own cash? And we're told this amount in the initial leverage multiple of 5 times. So we take 5x multiplied by 100 million, and that means we have $500 million of debt. And if you know your corporate finance, you know that everything else has to be financed by equity because we only have 2 options, debt or equity, in this relatively simple construction. And this also tells us that our initial investment is $500 million. So we are deploying $500 million of capital. And just FYI, this is probably where that upper middle market kind of price range begins. A lot of these upper middle market private equity firms are deploying this amount of capital. So the next step is where we're going to do a lot of the arithmetic. We're going to forecast out the income statement and cash flow statement, starting with revenue. We essentially have to go from revenue to free cash flow, and we're given the simplest items possible. So what we're going to do is revenue to EBITDA. We're going to deduct D&A and interest. Then we're going to calculate what tax is to get to earnings, essentially. And finally, once we're at earnings, we're going to add back D&A because it's a non-cash expense. And then we're going to deduct CapEx because that's a cash outflow. So let's walk through each step so you understand it. So the very first thing I would do in a paper LBO is just get out all the years. We start with 2021 and we're going to write that until 2024. So we have 3 years of forecasted financials. In the first year, which is essentially year 0 in 2021, it's $200 million and we'll go 225, 250, 275. And that's because it's $25 million every single year. So for EBITDA, what I'm going to do, first thing I'm going to write the margin. I know it's 50% held constant. And then I'm going to multiply that out for each of the EBITDA figures. So here's what I would calculate as the numbers, and it doesn't have to be perfect, but we would have 100 million in 2021, about 113 in 2022, 125 in 2023, and maybe call it 138 or 140 is fine for 2024. So after we have EBITDA, the next thing we're going to do is deduct D&A because it's still an income statement expense and we need to deduct it in order to calculate taxes properly. This is kind of a complex concept that we again cover in the course. I'm not going to dwell upon it here, but it's something you do need to understand. And for D&A, we only need this in the forecasted years. We don't really need to know it for 2021 because we don't need free cash flow in year 0. So I'm just going to multiply this out for D&A. It's roughly 23 million, then 25 million, and then 28 million. So the next calculation we need to do is calculate interest. We're going to go from EBIT to EBT. So for interest, we are going to multiply the initial debt, which we calculated in the first step, of $500 million and multiply that by 10%. And that means we have $50 million in interest every single year. The prompt tells us that we don't have to pay down debt over time. So it's going to be a flat 50 million. So why don't we pause here and roughly do some of these calculations so we get to EBT, which is earnings before taxes. So if you see this arithmetic, we can really start at the EBITDA level and we're going to deduct D&A. So 113 minus 23 is roughly 90 million. 125 minus 25, that's an easy one of 100 million. And 138 or 140, call it, minus 28 gets us to around 110. And I think you should be comfortable doing that level of arithmetic in your head. It's not hard, it's just something you need to get practice with. So after EBIT, we're going to deduct the same interest figure across the board. So we'll go 90 minus 50, 100 minus 50, 110 minus 50, and that gets us to 40, 50, and 60. Again, these are round numbers, and what we have to do next is deduct taxes. Now we've made the tax rate also easy at 50%, so you're just going to divide by 2, just a straight divide by 2. So then we'll get from 40 divide by 2 to 20, 50 divided by 2 to 25, and 60 divided by 2 to get to 30. So we're almost there. The last couple things we need to do are account for D&A, CapEx, and change in net working capital, but we've made this again easy for you because D&A and CapEx, as you remember, are both 10% of revenue, so they net against each other, meaning you don't have to do anything, and change in net working capital is actually 0. So in this particular example, net income is the same as free cash flow. So we can actually just take those net income figures we just computed and we're done the arithmetic portion of the LBO. So I will say that that part is definitely going to be the time-consuming part of the paper LBO, expected to take well over 50% of the entire question. So the third part is to calculate the debt pay down and the returns. So for the debt pay down, we're essentially wondering how much cash did this business generate, because we're going to use that to pay down all of the debt at the end of the forecast. And how do we get that? That's simply the cumulative numbers of free cash flow. So we're going to add up 20, 25, and 30. That gets us to a cumulative free cash flow of $75 million. We then go back to the first numbers we calculated. We started with $500 million in debt, and then we're going to deduct $75 million, bringing us to $425 million in ending net debt. So we'll hold on to this number for a second. The next thing we have to do is determine the exit price of the business. Essentially, this is the total value that we're going to sell the business for. We've held the business for 3 years, we've improved it, EBITDA has grown, and now it's time to sell it to maybe another private equity firm or a strategic acquirer. And because it's LTM EBITDA, we can actually just take 2024 EBITDA, which is $138 million. We're then going to do 138 multiplied by 10 because we're told that is the exit multiple. And that gets us to about $1,400 million in terms of exit enterprise value. And this exit enterprise value, for our purposes, we can think of as our full sale price. Now, in a normal LBO, there might be a bunch of other annoying stuff like fees or options or other kind of mechanics, but for most simple paper LBOs, it's going to be straight enterprise value as the sale price. So we're going to take that $1,400 million and deduct the net debt figure that we just calculated, which is 425. And this is where I think you can kind of liberally round. That's about 1,400 minus 400, and that would bring us to about $1 billion in terms of exit equity value. Now, if you remember and relate this all back to the first kind of principle we were thinking of, we wanted to know how much cash we're going to get at the end of our investment, and we're going to compare that to our initial investment. And this is the final part. So what we're actually just going to do here is divide. So we're going to take our exit equity value and divide it by our initial equity value. So 1 billion divided by 500 million, which is our initial investment, and that's 2 times. So that is our first very important investment metric. We've made a 2 times multiple of money. Now the next thing we have to do, and this is the clever calculation, but there is a mathematical phenomenon called the rule of 72. And essentially what it means is that if you take the number 72 and divide it by the number of years that you're holding an investment or an asset or a number, then if you divide those numbers, it just so happens that that is the implied compound growth rate, or as we like to call it in private equity, the internal rate of return. So this is the other really important private equity metric. The internal rate of return essentially tracks how fast an investment grows on a year-over-year basis. So what we're going to do is essentially 72 divided by 3 years of holding. And you can be very kind of approximate with this. It's around 24-25%. If you think about it, you can round 72 up to 75. Divide 75 by 3, that gets you to about 25%. So the answer to the paper LBO is 2 times MOM and 24-25% IRR. And just for your context, I would definitely describe that as a top quartile private equity return. Getting 2 times your money in 3 years is very good. Anything over 20% IRR in this environment is also very good. So I hope this was very helpful for you. This is something that definitely requires a lot of practice to get better, but trust me, it's very important to know for all of your private equity and buy-side interviews. Thanks for watching, and I will see you in the next one.